Markets taking a wait-and-see approach ahead of Fed Chair Jay Powell's testimony before Congress today and tomorrow. For more on how that testimony could impact market sentiment, let's bring in Kristen Bitterly, head of North America Investments at Citi Global Wealth. I don't know if you were watching earlier, but we are sort of waiting for data points. The bond market and stocks, I think, Kristen, in lull periods, not a lot of earnings, but we do have this testimony coming. Do you expect that to be market moving, or are you waiting for Friday and the inflation numbers next week?
I think we're waiting for Friday and inflation numbers. And I think even Chair Powell wished that some of this order was reversed in terms of his testimony versus the jobs report on Friday. The testimony, what are we expecting from that? I think we're expecting a lot of what we've already heard out of the Fed. And that 25 basis points is probably the base case, but he's going to talk about keeping it open, that they're data dependent, and not eliminating that probability of 50 basis points, because right now the market's pricing in about 30 basis points for the next Fed meeting. So I think he's going to focus on those points about being data dependent and keeping his options open. But the number that we got on Friday is significant on the back of what we saw in the January jobs report. And we want to see whether some of those data points out of January were anomalies, or whether the seasonally adjusted numbers, or whether there's something actually fundamentally different based on what the Fed has been doing in terms of tightening conditions in the economy.
There are, strategists that have remained bearish, but they've seen this most recent surprising move, maybe from the October lows, and then we had the solid January. Looked like we were ready to maybe give a lot of that back, and now we've held up. We've stayed above the 200-day moving average, and some of them are saying, you know what, this may have a little more staying power than I thought, but they're still not getting bullish. Are we going to go back down, Kristen, in below 3,800, below 3,600 on the S&P?
I think what's really interesting in what happened to the market year to date is just simply there's a lot of whiplash, and we're trying to hang on to different types of narratives. So what was interesting was when you look at January and the performance that we saw that was really, really strong in January from both an equity and fixed income standpoint, when you break down the composition of that, it was really 10 stocks that contributed about 40 to 45% of that rally. So it wasn't a quality rally. And then February, obviously on the back of kind of the resilience of the consumer and the strong jobs report, the market quickly then tagged onto that narrative. And is it higher for longer, or maybe the economy's stronger than anticipated? And so looking right now, I think we're in a little bit of a holding pattern. But one thing that we're keeping in mind, and this is why we're playing defense within our portfolios, no, we're not sitting on the sidelines, we're playing defense, is we have this March Fed meeting, but then we have until May, until the next Fed meeting. And so there is a lot of data that is going to come out in terms of Q1 earnings. We're going to get all of that data. And so I think, yes, we're going to see some choppiness potentially short term, but there's a lot of data. So I don't think that we can be very definitive on the Fed's trajectory from here, because as we said, they're data dependent, and there's a lot that's going to come out over the next 2 months.